The story begins in Wilsonville, Oregon, a quiet town shrouded in mist and machinery. Inside an inconspicuous building, a steady hum of pumps fills the air. There, behind reinforced walls and coolant lines, something extraordinary is happening. Iron is flowing, not molten, but liquid in a chemical dance that stores electricity for hours, even days. That flowing iron lies at the heart of a company called ESS Tech, one of the most ambitious energy storage ventures in the United States. For viewers watching this as a short, you can click the full version link below to listen to the complete story seamlessly from start to finish. Founded in 2011, ESS Tech Inc., NYSE GWH, is a long-duration energy storage company headquartered in Oregon. Its signature innovation is the iron flow battery, a technology that uses salt water and iron electrolytes instead of lithium. Unlike lithium-ion batteries, which are flammable, expensive, and limited in cycle life, iron flow batteries are non-toxic, non-flammable, and made from abundant materials. They can operate for tens of thousands of cycles without significant degradation, a potential breakthrough for the renewable energy grid. On paper, it's a perfect fusion of chemistry and sustainability. But investors understand that there's a world of difference between an elegant theory, and commercial reality. ESS Tech designed three distinct products: Energy Warehouse, Energy Center, and Energy Base, each targeting a different segment of the energy storage market. The Energy Warehouse is a compact, behind-the-meter system for commercial sites. The Energy Center is a modular, scalable solution capable of multi-megawatt installations, and the Energy Base is a grid-scale platform intended for utilities and industrial storage exceeding tens of megawatt hours. Together, these systems embody a logical roadmap from pilot to full-scale deployment, a model that most new energy technologies follow. Usually, companies demonstrate small projects first, then secure performance data, then expand into large contracts. At least that's how it's supposed to go. In October 2021, ESS Tech went public through a merger with Aecon S2 Acquisition Corp., debuting on the New York Stock Exchange under the ticker symbol GWH. The market's reaction was euphoric. Investors hailed ESS as a post-lithium pioneer, the kind of company that could redefine energy storage in the age of renewables. Yet the excitement faded quickly. Production delays emerged, reported revenues were negligible, and quarterly losses widened sharply. The very scalability that had made the technology promising now became its burden. Then came a headline-grabbing announcement. In September 2022, ESS signed a framework agreement with Sacramento Municipal Utility District, SMUD, for up to 200 megawatts and 2 gigawatt hours of iron flow battery capacity, one of the largest long-duration storage contracts in the United States. The deal positioned ESS as a key partner in California's decarbonization plan. But after the announcement, something strange happened. Silence. Ordinarily, such large contracts trigger a cascade of follow-up disclosures: site schedules, production milestones, installation timelines. Investors expect to see a pipeline unfold. Yet ESS released few details. Deliveries appeared to stall. No major revenue recognition followed. It suggested one of several possibilities. Either the SEMA deal was still in early framework stages with no guaranteed offtake, or the company had encountered manufacturing bottlenecks. Both explanations were plausible, but troubling. In January 2025, ESS tried to turn the narrative around. The company announced the commercial launch of its Energy Center product, claiming its first delivery to a Florida-based utility and the completion of a demonstration project with Portland General Electric, PGE. 2 months later, it confirmed the first grid interconnection of an Energy Center system, the final step toward commercial operation. For most firms, this would signal the start of consistent revenue. But just as momentum seemed to build, a shockwave hit the company. On February 14, 2025, CEO Eric Dresselhuys abruptly resigned. The company offered no detailed explanation. That timing, immediately following a long-awaited commercialization milestone, was anything but typical. In corporate practice, CEOs rarely step down at the moment a product line is validated. Such exits often follow crises or internal disagreements, not breakthroughs. The abruptness of the departure and the lack of communication raised eyebrows across the investment community. Within days, Kelly Goodman was appointed as interim CEO. Under her leadership, ESS declared a strategic pivot. shifting focus away from Energy Center toward Energy Base, its largest scale offering. It was a bold and risky move. Normally, firms refine smaller systems first to ensure stable margins and supply chains before committing to capital-intensive utility-scale projects. But ESS jumped straight into the deep end. Why? Analysts proposed two main hypotheses. First, that large-scale systems might offer better unit economics, as fixed costs could be distributed over greater energy capacity. Second, that technical or quality issues in smaller units made scaling them unviable. In either case, it hinted at deeper operational stress, a tension between technological aspiration and manufacturing reality. In April 2025, ESS was named to Time's Top Green Tech Companies and Fortune's Most Innovative Companies in America lists, accolades that would normally mark the peak of momentum. Yet the financials painted a sobering picture. Annual revenue was only about $6 million, while net losses exceeded $75 million. Earnings per share were roughly minus $6, and the market capitalization hovered around $140 million, a steep decline from its post-listing highs. For a company celebrated as a sustainability icon, its numbers looked anything but sustainable. By May 2025, the company reaffirmed its focus on Energy Base, and in August, brought on COO Jigish Trivedi to streamline production and improve execution. The announcement was meant to inspire confidence, yet investors were still uneasy. Then came October, and another twist. On October 9, 2025, ESS announced a 50 megawatt-hour, 10-hour duration pilot project with Salt River Project, SRP in Arizona, under a 10-year contract. It was on paper a milestone deal, the kind that could cement the company's reputation as a commercial player. But only 5 days later, on October 14th, the company disclosed a $40 million financing arrangement with Yorkville Advisors to strengthen liquidity. To seasoned investors, the timing felt off. Typically, signing a decade-long project with a major utility brings cash inflows, not immediate financing needs. The back-to-back announcements raised uncomfortable questions. Was the SRP contract structured without upfront payments? Was ESS forced to fund manufacturing before receiving revenue? Or had the company's cash reserves already run dangerously low? Each possibility pointed to the same underlying issue, a widening disconnect between technological progress and financial stability. The company's iron flow batteries may be resilient, but its balance sheet was anything but. As of late 2025, ESS Tech's Oregon facility still hums with activity. Rows of cylindrical tanks circulate deep orange electrolytes while sensors flicker along steel corridors. Inside those chambers lies the promise of cleaner, longer, safer energy storage. But outside, in the financial markets, investors are asking a different question. How long can innovation outlast the cash burn? ESS Tech embodies the classic paradox of the energy transition, a technology that could change the world, trapped in a business model struggling to survive it. Iron may flow endlessly, but capital does not. Finally, the Valuester channel invites you to share your insights. If there's a stock, listed, private, or soon to go public, or a digital asset you believe deserves a closer look, leave your thoughts and tips in the comments. To all our listeners who watch, subscribe, like, comment, and share our videos, thank you for your support and engagement. We'll continue to deliver deeper, sharper, and more insightful stories about the mysteries shaping today's investment world. This was Valuester.